A very good morning. This presentation is brought to you by Resonate International with a mission to leverage knowledge worldwide. The topic being covered is China's global lending, strategic leverage, economic returns, and global consequences. Ladies and gentlemen, over the past 2 decades, China has expanded its lending portfolio globally, positioning itself not only as a major lender but also as a significant force shaping economic dependencies worldwide. This massive portfolio, led by initiatives like the Belt and Road Initiative (BRI), has one distinct purpose: to secure economic returns that bolster China's economy while extending its influence across continents. China's global loans now exceed $1 trillion, spanning countries in Asia, Africa, Latin America, and Europe. Through the BRI, China has funded infrastructure projects including ports, highways, and power plants, promising development in low to middle income nations. With an estimated $1.3 trillion invested in over 150 countries through the Belt and Road Initiative alone, China's global loan portfolio encompasses infrastructure, strategic assets, and crucial natural resources. The question arises: how much does China actually gain from these interest payments? Estimates suggest China earns tens of billions annually through interest alone. This revenue is then channeled back into the Chinese economy, supporting domestic development and reinforcing its financial standing globally. Let's explore a bit more in detail China's lending model, the significant annual returns it garners, the implications for borrowing countries, including the United States, and an approach for a balanced, sustainable global lending environment. Under the BRI, China's investment targets critical infrastructure projects globally. Pakistan, with over $10 billion in loans for projects like the Gwadar port, Pakistan faces high interest payments that deepen economic dependence. Kenya borrowed $5 billion to construct its standard gauge railway at a 6% interest rate, resulting in annual repayments exceeding $450 million, more than twice the rate charged by multilateral institutions. Sri Lanka owes around $8 billion to China. Its inability to repay led to a 99-year lease of the Hambantota port to a Chinese company, granting China a strategic maritime asset. Argentina holds over $19 billion in Chinese loans for energy and infrastructure, costing it millions in annual interest payments. Zambia accrued $6 billion in debt, largely for copper mining and infrastructure, and faces significant economic strain under these obligations. Djibouti and Kyrgyzstan owe over 70% of their external debt to China, creating high repayment obligations that strain national budgets and raise debt sustainability concerns. This vast lending activity presents risks to global financial stability. Countries heavily indebted to China face potential fiscal crisis, as witnessed in Zambia. Debt dependency can reduce the borrowing country's flexibility in policy making, leading to long-term economic and political consequences. Furthermore, the accumulation of strategic assets gives China leverage that could be utilized to influence policy decisions, potentially reshaping regional alliances. Besides above, China has invested in land and assets across various countries, further diversifying its international holdings. For instance, Chinese entities own large agricultural lands and strategic infrastructure in regions from Africa to South America, enhancing its global economic footprint and strategic positioning. Chinese entities, for instance, control over 70% of the Democratic Republic of Congo's cobalt mines, an essential raw material for electric vehicle batteries. In South America, China's substantial holdings in copper mines in Peru and Chile account for a major share of China's imports, almost 60% in critical minerals, further diversifying China's economic footprint and influence. In Ethiopia, China holds extensive stakes in railway and energy projects, owning portions of the country's critical transport routes. Considering above, China's such investments are estimated to value at approximately $4 trillion across sectors and across countries. What are the annual returns which China gets, and how the interest rates stand in comparison? China's loans typically carry higher interest rates than those from international financial institutions. While the World Bank and IMF offer concessional loans with rates averaging 1 to 2% for low-income countries, Chinese rates hover between 4 to 6%. This difference yields China an estimated $50 billion in annual interest income from global loans alone. These revenues feed back into the domestic economy, supporting China's infrastructure, research and development, thereby fueling national growth and enhancing technological competitiveness. For example, Angola's $20 billion debt to China generates approximately $2 billion annually in interest payments. By accumulating such annual returns, China builds a revenue stream that fuels both its domestic economy and international ambitions. What is the China's position in the US debt market? In addition to developing economies, China holds significant financial influence in the United States, owning approximately $860 billion in US Treasury securities. This makes China one of the largest investors holding US debt a position that grants it indirect leverage over US economic stability. Fluctuations in China's US Treasury holdings could impact American interest rates and financial markets, thus underscoring the interdependence between these two major competing economies. At a time of increasing competitiveness and competition, this financial entanglement adds another layer of complexity to their economic relationship. The strategic leverage and borrowers' risks as involved in this whole landscape are essential to look at. China's lending strategy has been termed debt trap diplomacy by some analysts, as several countries become financially dependent and face the threat of asset seizures. In cases of debt distress, Chinese entities have acquired control over critical infrastructure. For example, in Sri Lanka, the Hambantota port was leased to a Chinese company for 99 years after the debt repayment became unmanageable. This control extends China's influence over key shipping routes in the Indian Ocean. Similarly, China holds substantial mining interests in Africa, owning stakes in cobalt mines in the Democratic Republic of Congo, which supplies around 70% of the world's cobalt, crucial for battery production. China's strategic use of debt binds these nations into political alliances, subtly enhancing its global influence in regions critical to global trade and security. The question arises, why nations enter high-cost debt with China? There are several factors which drive these countries to take on Chinese loans despite known risks. First is rapid infrastructure financing. Many developing nations face urgent infrastructure needs that traditional lenders, including the IMF and the World Bank, may not fund promptly or sufficiently. Pakistan, for example, turned to China for immediate support to finance the Gwadar port, a critical project to expand trade. Fewer governance conditions is the second factor. While IMF and World Bank loans often require governance reforms, Chinese loans generally avoid such stipulations, making them attractive to politically transitional or governance challenged nations. The third is growth initiatives in emerging markets. Many sub-Saharan countries, for example, see Chinese loans as means to boost connectivity and economic growth despite higher long-term costs. Ethiopia's railway and energy projects, financed largely by China, aim to transform its regional trade access, even with significant repayment risks. What is the way forward in which balancing mutual benefits and sustainability can become a reality? In navigating this complex financial landscape which we discussed, a balanced approach is necessary. Increased transparency in loan terms, coordinated debt relief efforts, and diversified lending sources are essential steps. Multilateral institutions, could provide support to nations seeking more balanced funding options, thus promoting a healthier global financial ecosystem. Additionally, countries could implement strategic policies to prevent over-reliance on any single lender, ensuring economic stability and sovereignty. Achieving a sustainable lending framework that respects both lender and borrower interests requires reforms from both sides. For China as a lender, by adopting international lending standards, including transparent loan terms, China can help avoid borrower distress, reducing the need for asset seizures. Diversifying repayment options, offering longer grace periods, and restructuring debt for distressed nations can safeguard stability, creating reliable, lasting partnerships. For borrower countries, enhancing debt management, diversifying funding sources, and balancing Chinese loans with multilateral financing will foster economic stability and reduce dependency risks. Sovereign wealth funds, for instance, can act as financial buffers, helping countries manage debt obligations without compromising national autonomy. In conclusion, ladies and gentlemen, China's global lending program is more than a financial venture. It is a strategy to generate returns that fuel its economy while extending its influence. By drawing nations into its economic orbit, China is not only feeding its growth, but also shifting global power dynamics in its favor. China's lending model has transformed the international financial landscape, channeling critical development funds and creating pathways for its economic and geopolitical aspirations. These loans fuel China's growth through substantial returns and global asset control, impacting regions vital to trade and resource security. For borrowing nations, China's financing brings immediate opportunities, but often at the expense of fiscal and strategic independence. Considering above, the stakes are undoubtedly high for the future of international financial stability. And this poses a question for global policymakers: how to engage with a lending superpower like China in ways that preserve financial sovereignty and prevent economic dependency. To promote a stable and equitable global financial system, a cooperative approach is essential. By fostering transparent, responsible lending and borrowing practices, all stakeholders can ensure that economic progress supports long-term prosperity without compromising national sovereignty. In this vision, China and its partners create an environment where development thrives on mutual benefit, fostering a global economic order rooted in fairness, stability, and shared progress. Good luck, best wishes, and God bless.